Good afternoon, everyone. Thank you for being here today. My name is Lee Reines. I'm the director of the Global Financial Markets Center at Duke Law, and today it is my privilege to welcome our distinguished guests from the Volcker Alliance, Tom Ross, Mike Bradfield, and Gaurav Vasisht. Tom Ross was appointed president of the Volcker Alliance in May 2016 after having served as president of the University of North Carolina system from 2011 to 2016, where he remains president emeritus. Mr. Ross also serves as the Terry Sanford Distinguished Fellow in Public Policy at the Sanford School for Public Policy here at Duke, and as a professor of public law and government at the UNC Chapel Hill School of Government. Mike Bradfield was the Volcker Alliance's general counsel as well as a board director. He's the former general counsel of the Federal Reserve Board as well as the Federal Deposit Insurance Corporation. Mr. Bradfield was a former senior partner for Jones Day and assistant general counsel of the U.S. Treasury Department. Gaurav Vasisht joined the Volcker Alliance in 2014 and serves as the Director of Financial Regulation. In this role, Gaurav oversees all aspects of the Alliance's work on financial regulatory matters. Prior to joining the Alliance, Gaurav served as Executive Deputy Superintendent of the New York State Department of Financial Services, heading the agency's banking division. Gaurav has also served as Senior Deputy Superintendent of Insurance, First Assistant Counsel, and Assistant Counsel to 3 governors of New York. The Volcker Alliance was launched in 2013 by former Federal Reserve Board Chairman Paul Volcker to address the challenge of effective execution of public policies and to rebuild public trust in government. Today, our guests will be discussing areas of vulnerability in the financial system and what policymakers can do to address them. Their findings and recommendations are detailed in the Alliance's recent report, Unfinished Business, Banking in the Shadows. We hope to have about 10 to 15 minutes at the end of their presentation for audience questions, so please hold them until then. And with that, I will turn it over to Mr. Ross for some brief remarks.
Thank you. It's a pleasure to be here. And I say that even as former president of the University of North Carolina. One piece that Lee left out was I also served as president of Davidson College, which I have to say because one of our students is here. And my allegiance remains heavily with the Wildcats. It's a pleasure to be here. And I know about this much about banking and banking regulations, and what I learned from these two people. They know it, they're smart, they're amazing, but I wanted to talk to you just for a second about the Alliance and the work we do, and maybe a little bit about public service, because I think it is a time in our history when serving the public in a variety of different ways, and particularly serving in government, is important, and it's really important to attract people like you into government. So I think it's important for several reasons. One is it exposes you, if you were ever to go that route, to a side of whatever issue you're interested in that you might not really understand fully without serving in the public, and you can talk to Lee. I mean, Lee served in the Federal Reserve, for example. These two guys have served in government. I've served in government, and I think we're all lawyers. All the people you're looking at up here are lawyers. And so, we've done that, and I think it has served us well in our careers, and we've been able to move from one place to the other, but we've also hopefully made a difference, and at the same time learned a great deal that has benefited us. So I hope you will think about public service as you plan your careers. And nowadays, people change jobs a lot. So they move into government, they move out of government at different stages, and it is a unique and I think important opportunity. I mention that in part because Paul Volcker, who formed the Alliance and who served as the chair of the Federal Reserve from 1979 to 1987, under a president who was a Democrat and a president who was a Republican. He served nearly 30 years, served in the public good for nearly 30 years, while he also had a distinguished career in the financial industry. He came back out of retirement, in fact, to serve as the chair of President Obama's Economic Recovery Advisory Board. So this is a man who has dedicated a good portion of his life to the service of the public. And I suspect if you have any interest in financial regulations, or if you have any interest in the history of inflation in the United States or a number of other things, you've heard his name. And you recognize him as a great public servant. And I think his latest endeavor to create the Alliance, as he told me, he said, I don't need a legacy. I just want to make a difference. And I think that says the kind of person he is and the kind of public servant he has been. The Alliance has been involved in financial regulation work since its inception. Gaurav leads our work, and I will tell you, I've listened to a lot of conversations in which he's been involved, and I don't think you could find anyone who understands the regulatory landscape, the good and the bad of the way it's structured and organized, and the issues that we face moving forward as well as he does. It was mentioned that he is going to address, and as is Mike Bradfield, who worked with Mr. Volcker and who knows the Fed as well as anyone, and financial regulations as well as anyone as well. They're going to talk about our most recent report, Unfinished Business, Banking in the Shadows. Prior to that, however, we have issued another significant report on reshaping the financial regulatory system. Both of those are available on our website. If you're interested in these issues, you really should take a look at both of them. I think they're excellent papers and bring a lot of good thoughts to the table. So I'm going to stop, turn it over to the people who know what they're doing. Thank you for allowing me to show up, and I wore a Duke tie just for you. See you.
So I guess I'll start off. Thank you to Lee Reiners and to Duke Law School for inviting us to speak here today. This is an excellent opportunity for us to talk a little bit about the Volcker Alliance's report, Unfinished Business, Banking in the Shadows. The report was issued this past December, along with two working papers, the first of which was on clearinghouses for OTC derivatives, and the second of which was on the asset management industry. I'm going to confine my remarks today to the overarching report, the purpose of which is to highlight certain vulnerabilities in the financial system that have the potential to cascade into a systemic crisis and damage the real economy. The purpose of the report, it's important to say, is not to prevent the failure of individual financial institutions. In fact, we believe that the risk of loss and the risk of failure are essential components of a well-functioning market. So again, our focus in the report is really the type of vulnerabilities that can damage the real economy and inflict pain on real people in terms of loss of jobs, loss of homes, the loss of household wealth, and loss of credit. The report has three overarching components. First, the risks associated with excessive use of uninsured short-term funding, and this is where we spend the bulk of our time in the report. Second, clearinghouses for OTC derivatives, which have increased in both importance and risk in recent years. And third, the highly fragmented and outdated system for regulating financial institutions in the United States, which deprives regulators of not just a complete understanding of the financial system in terms of the risk that it poses, but also the tools that are necessary to address those risks. To be clear, the report doesn't deal with every issue of financial stability, many of which should be prioritized, but still remain outside the scope of the report. And one important issue in that respect is GSE reform, which the report doesn't touch on, but nonetheless is a very important issue in terms of stability. So let's talk about short-term funding. This chart is a very important chart. It lists the instruments that are included in our definition of what is short-term funding. It includes repos, securities lending, commercial paper, asset-backed commercial paper, money market mutual fund shares, uninsured deposits, and Eurodollars. I'm not going to spend a lot of time talking about what these instruments are and how they work. If you're unfamiliar with them, there's a handy glossary at the end of the report that describes what all these instruments are. And there are plenty of papers that are cited in the report that have a very good background section on how these instruments work, and I'd recommend that you look at it. And I would say that you should look at it because this is the plumbing of the financial system. This is very important to understand. This is essentially some describe it as the nervous system of the financial system. Some describe it as the circulatory system. Others say that it's sort of the plumbing. So I would highly encourage that you try to get a good handle on how these instruments work. The data that are presented in this chart are presented on a gross basis, which is appropriate since we're trying to identify and quantify each runnable instrument. The methodology that is used is based on a book by Morgan Ricks, called The Money Problem. Morgan's a professor at Vanderbilt who wrote an excellent book last year, and I recommend that everybody pick it up and read it. Methodology is also similar to a methodology used by economists at the Federal Reserve in a paper called The Runables. There are many ways of defining and quantifying short-term funding, sometimes called money-like instruments or safe assets. And those include Greenwood, Hansen, Stein, Gordon, Llewellyn Metric, Krishnamurthy, Vissing, Jorgensen. But whatever methodology you use, the trajectory is generally the same. You see a rise in the years leading up to the crisis and then a dramatic fall. In this chart, you see a subsequent rise in recent years, and I think it's important to note that that rise is attributed to an increase in recent years in uninsured deposits. And in fact, non-deposit short-term instruments have seen a decline in recent years. So this is important, and it's good that we've seen a decline in recent years, but as we say in the report, policymakers shouldn't become complacent because there's been a decline in recent years. The report makes some very important and basic points on short-term funding. First, it results in what's called maturity transformation, which is essential for economic growth, but also inherently dangerous and makes short-term funding prone to runs. So what do I mean by that? What you're doing essentially is you're using short-term funds to finance long-term obligations. So think about deposits in a bank. You put in money, that money then gets turned into long-term loans to households and businesses. And that maturity transformation is very important for economic growth and for how businesses function, but it also makes it vulnerable to runs. If everybody starts to take their money out of a bank right away, the bank's not going to have enough to pay everyone back, and you can have a run, and then that can turn into a full-blown panic. And of course, the risk isn't theoretical. It was at the heart of the last financial crisis, 2007, 2008, as well as the banking collapses throughout the 19th and early 20th centuries. The post-crisis reform has been very important and been effective, but it has not directly confronted the risk of short-term funding. In fact, the use of short-term funding continues to be incentivized by the bankruptcy and tax codes, and market participants still do not internalize the social cost of its risks. Now, Mike Bradfield is going to talk a little bit about, when he speaks, he's going to talk a little bit about the post-crisis reform and what's been effective and what's been lacking, and I'll let him talk about that. And while it's true that non-deposit short-term debt has declined in recent years, it is expected to rise as monetary policy normalizes. So the basic thrust of our argument in the paper is that absent assertive action, uninsured short-term funding will remain a potential threat to the stability of the U.S. financial system. So let me just restate this more simply. One, short-term funding is dangerous because of maturity transformation. It was at the heart of the last crisis and of the crises in the past. We haven't effectively dealt with it. We continue to encourage it. It's expected to rise as monetary policy normalizes. So it's in our interest to fix the problem now so that we don't face the same issues one more time. This is not to say that we know where the next crisis is going to occur, but it's we get a pretty good sense of the problems that short-term funding, if uninsured and unregulated, can lead to in the financial system. So what are we going to do about it? The report presents policy options that can be categorized in two buckets, near-term incremental and long-term structural. The near-term options are pretty straightforward, and I can describe them relatively quickly. The long-term policy options are much more complex. We don't endorse any one of the long-term options over another, but we note that each has the potential to make the financial system safer. But we do say that their moral hazard, monetary policy, and practical implications should be considered before they are implemented. So I'll first describe the incremental approach very quickly. We recommend that all money market funds and their close substitutes be required to publish a floating net asset value. Money market funds prior to the crisis were on a stable net asset value. This made them function very much like deposits in a bank, and yet they were uninsured and not regulated like banks. And then when we saw when Lehman collapsed, the reserve primary fund, which is a money market fund, experienced a run. It broke the buck, essentially, and all the investors started to redeem. And so what we recommend to fix this problem is for all money market mutual funds and their close substitutes to be on a floating NAV. We have seen some post-crisis reform in this area. We've seen a subset of money market funds go on a floating net asset value, but we say that that's not sufficient to fix the problem, and that the reform should be more inclusive of all the funds and their close substitutes. We also recommend that the bankruptcy safe harbors from the automatic stay normally applicable in insolvency should be narrowed to include treasuries and agencies backed by the full faith and credit of the United States. To break that down a little bit, as you know, when there's a bankruptcy proceeding, there's what's called the automatic stay. Everything is stayed. Well, there's an exemption from the automatic stay for qualified financial contracts. And QFCs include short-term contracts like repos, and it also includes derivatives. And so what happens is that the counterparties that are exempt from the automatic stay are able to seize the collateral and immediately sell it. And when they do that, there's a massive dumping of collateral in the market, which then puts a downward pressure on asset prices. And anybody holding those assets or similar assets then is forced to engage in fire sales of their own. So it results in a market-wide fire sale. And so what we are recommending in that recommendation is that we narrow the scope of what fits within that exemption, that not everything should be thrown in that exemption, not everything should be able to be dumped, that there's a policy reason behind having treasuries fit within that exemption, but more exotic instruments like mortgage-backed securities, CDOs, et cetera, shouldn't fit within that. And you see, if you study the bankruptcy code, you see that the bankruptcy safe harbors were liberalized starting, well, you saw the first one enacted in 78, then 82, 84, 1990, and then following that in 2005. And the ultimate effect of the 2005 amendment was to just broaden it so much so that pretty much everything fits. And then we saw the dumping of that collateral during the crisis. We also recommend that regulators get a better sense of the securities lending and bilateral repo market. It's remarkable when you think about it that regulators don't have a clear understanding of the particulars of the sec lending and bilateral repo markets. And by that I mean the nature of the collateral, the tenor, the maturity, the parties. We have agencies doing a really good job in trying to figure that out. The Office of Financial Research, together with the Federal Reserve, and the SEC have been working to figure out this market a little better, but much more needs to be done, and we hope that that work continues in the new administrations. We also recommend that we continue to develop strategies for non-bank resolution, and here I'll mention hedge funds. If LTCM were to happen today, are we any better off than we were 17 plus years ago? And of course, many would say that hedge funds today are very different from what hedge funds used to be back then. But the Lou Treasury Department had done some very important work looking at the largest, most levered hedge funds, and it appears much more attention is needed here. And if anyone's interested in this area, you should pick up the analysis that the Treasury Department has put out on, the Treasury Department last year had put out on hedge funds. They had a whole working group on hedge funds. So you should, it's great reading, you should look at it. But the central point on hedge funds, and this goes to the regulatory structure also, is that each single regulator has a clear understanding of the risk profile of these hedge funds. And there are just significant data gaps in trying to get a handle on the risk that the hedge funds could pose. Not every hedge fund, obviously, and not even every hedge fund in the subset, but I think there's a real policy interest in getting a better sense of what risks, if any, hedge funds pose to financial stability. The report then offers three structural approaches. The first one, and I'll run through these very quickly. The first one would establish, and again, these are not approaches that we're endorsing, we're offering them for greater discussion. The first one would establish a quantitative limit on the issuance of short-term debt by certain non-bank financial institutions. And here I would say there's a very simple premise. Short-term funding, maturity transformation are functions of a bank. And so simply put, if you're not a bank, you shouldn't be engaged in bank-like behavior. And so that is the sort of the underpinning of the first structural approach. The second, and Mike I think might amplify on that approach in his remarks. The second approach would require banks and non-banks to pre-position collateral with the Federal Reserve that they can borrow against during a crisis. And then their short-term liabilities would be limited to the amount pre-positioned, subject to a haircut determined by the Fed. And for anyone who's interested in learning more about this, this is an approach in Mervyn King's recent book called The End of Alchemy. It was published last year. The former governor of the Bank of England, and he calls this approach the pawnbroker for all seasons. And so if anyone's interested in learning more about this, you should pick up that book and read it. The third approach, the third structural approach that we've highlighted in the report, would use the Federal Reserve's balance sheet as a financial stability tool, but allowing it to crowd out private maturity transformation through the issuance of genuinely safe assets such as central bank reserves and reverse repos. And this is an approach that's highlighted in a paper, Greenwood, Hansen, and Stein. Jeremy Stein used to be a governor on the Federal Reserve Board, now in faculty at Harvard, along with his colleagues put that together. But the intellectual underpinning of all that work is also captured in many other academic articles written by them and by other economists at various universities. The benefit of these three proposals is that they directly would address the risks of short-term funding, but they each have challenges. Placing quantitative limits would require fundamental changes in how finance is intermediated. Requiring the pre-positioning of collateral would put the Fed in a very difficult position of determining haircuts in normal times. And the crowding out approach could expose the Fed to fiscal risk, have implications for Federal Reserve independence, and require the Fed to have a permanently large balance sheet. Again, we offer these three structural approaches because they have the potential to make the financial system safer. But again, I think a robust conversation on their implications in terms of moral hazard, monetary policy, and practical implications should be had before we move towards implementing them. The second overarching piece in our report deals with clearinghouses for OTC derivatives. The report notes that while central clearing is required under the Dodd-Frank Act has made the system safer overall, credit risk has become concentrated in a small number of systemically important clearinghouses. And their incentives, risk management, and regulatory standards have not been realigned with their public purpose of mitigating systemic risk, and their stress or failure could be catastrophic. When you think about it, you've got all these clearinghouses. Every large bank is a clearing member of one of these systemically important clearinghouses. Many of them have cross-margining agreements, and so you could see that the stress at a large financial institution that's a member of one of these would wind up putting a lot of stress on the clearinghouses, which could then impose stress on other members. So it could function as a transmission or a channel for transmission of stress to the rest of the financial system. So we recommend in this report that policymakers try to fortify clearinghouses, first by determining what their ideal governance and ownership structure should look like, including whether they should be functioning and be regulated as a utility. We would also establish a framework for their regulation and supervision so that adequate regulatory standards can be developed Right now, we have a system, regulatory system, as it pertains to clearinghouses or CCPs, which is basically a hodgepodge of all sorts of regulators. You have the SEC involved, you have the CFTC involved, and you have the Federal Reserve involved. And what we would recommend is that we have a better put together regulatory system so that they can be regulated and supervised in a fashion that makes much more sense. We would also recommend that there be a clear recovery and resolution statutory framework. It's unclear whether Title II of Dodd-Frank, which is about resolving systemically important financial institutions, would actually apply. Many legal experts say that it would, some others say that it probably wouldn't. Another question is, even if it did apply, would it really be helpful? And it's important to note that there's a lot of work being done internationally and domestically on this, on resolution of clearinghouses, and we hope that that work continues because it is important and it is something that we need to keep monitoring. Because if there's stress, CCPs or clearinghouses could actually pose a significant risk. The third overarching piece of our report deals with the regulatory structure itself. The regulatory system is rigid, disjointed, highly fragmented. It's not a creature of design. It's a function of political compromise and quid pro quos. And it was put together and developed over time by people who could never have fathomed the shape of modern finance, and it reflects it. It's a hodgepodge. It's all over the place, and so that creates challenges with implementing financial stability policy, with challenges in terms of regulating and supervising non-bank financial institutions. It results in this artificial bifurcation of securities and derivatives, and it results in a lot of overlaps and inefficiencies. So we would recommend in our report that the regulatory system be reshaped and modernized. We would strengthen the FSOC by streamlining its decision-making, insulating it from outside influence, and allowing it to better address areas outside the reach of prudential regulators. We would consolidate the supervisory responsibilities of the banking agencies as well as the SEC and CFTC into a prudential supervisory authority, a new agency. We would reinforce the Federal Reserve's role as the systemic risk regulator, giving it rulemaking authority over entities supervised by the Prudential Supervisory Authority. We would keep the FDIC involved with resolution and even give it backup examination authority. We would combine the CFTC and the SEC into one independent agency that would have independent funding. Right now, both agencies are funded through congressional appropriations, and that's had over time, that's had a very devastating impact on the capacity of both agencies. And we would eliminate the OCC. Now, let me talk a little bit about the political reality of all of this. There's no question that the evolving political landscape makes the recommendations in this report challenging, but there are some pieces of the report that would have significant appeal to policymakers on both sides. I think a revised regulatory structure that makes much more sense, streamlines government, would reduce regulatory burdens on financial institutions and lead to better, smarter, more targeted regulation. So that should be appealing. Some other pieces of this report wouldn't require legislative changes. But I will say that as the political landscape changes, we have seen a significant increase, in terms of people voicing their concerns with economic growth and reduced market liquidity. And so some of the core pieces of Dodd-Frank have been talked about in terms of rolling back or dismantling. And the one caution that I would have is that dismantling such a comprehensive reform in sort of a disorderly fashion without fully thinking things through might not put us on the path to prosperity, as many promise, but rather put us on a march to the next crisis, and that we have to be very vigilant and watchful of the changes that might happen. So some examples might be Title II, which is what I mentioned. Title II is the part of Dodd-Frank that basically gets rid of taxpayer-funded bailouts, and it's very important to keep. Certainly better capital, more capital and better quality capital is very important. So is liquidity. The CFPB, in terms of consumer protection, is a very important agency. So I think it would behoove all of us to remain watchful in terms of what changes are planned. There are some changes there might be some changes that would have a very positive impact, and I think those should be facilitated. But the last thing we should have is a rollback that's not thoughtful, and we're optimistic that that's not going to happen. So I'm going to stop here and let Mike take over and talk about his pieces.
I want to join with my colleagues in thanking Dean Rice for inviting us, and we're very pleased to be able to communicate with you about financial policy. I want to say that I'm particularly delighted to be here because I've never been to North Carolina before. I'm of an advanced age, and it's quite remarkable that I have had the pleasure of being here. And what I've seen is what's make me come back. I also want to talk to you in the context of, I think you're going to be living the Chinese curse. May you live in interesting times. We have seen in the United States a period of relative calm in financial markets for an extended period of time, from 1933 to 2007. We didn't have a financial panic in the United States. In 2007, 2009, we had a financial panic and a Great Recession, which sort of marks a watershed. In response to that, Congress adopted in 2010 the Dodd-Frank law, which contains a really substantial substantial improvements in the financial system that would be important in preventing the repetition of what had happened in 2007, 2009. And I want to point out that the focus of the two reports that Gaurav has described is maintaining and establishing and maintaining financial stability. And I want to emphasize that financial systemic stability is an enormously important value. Losses in the 2007-2009 period, losses in the U.S. to ordinary Americans ran in the trillions. Now, that reminds me of the former senator from Illinois, Everett Dirksen, the great conservative, is quoted as saying, a billion here, a billion there, pretty soon you'll get into real numbers. Well, now it's a trillion here, a trillion there, and you are into very big numbers. And the consequences are enormous. The loss to the value of homes, for example, not only the many, many thousands of foreclosures, but the losses in value to people's homes have greatly affected their psychology and their confidence, both in government and in their financial futures. That's their biggest investment, and their value went down substantially, and in some places you couldn't sell a house at all. So my emphasis of my point is that financial stability matters, and the societal costs of making a mistake are too high to permit a recurrence. So we're going to be living in a time when in response to all these events of the 2007, 2009 resulted in substantial improvements, and whether those improvements will remain part of the law of the United States, and whether we will be able to, as a country, be able to avoid the kind of financial shocks that had such devastating consequences in the past. And our report is focused on two important parts, as Gaurav has indicated. One was, his part was regulatory consolidation. We have a regulatory system that is bifurcated, each agency looking at, with blinders, looking at a small part of the problem, nobody looking at the overall aspects of the problem. And that, in the end, led to the inability of the regulatory system to react adequately to the changes in the financial system that Gaurav has described, and we have to end those blinders and establish a regulatory system that has a 360-degree view of the system. Derivatives, securities, trading, and banking. All those things need a consistent ideology, a consistent theory of how they're going to carry out their activities, and a consistent response to risk. And the other part is of the report is on decreasing reliance on panic-prone short-term debt that Gaurav has so adequately described, and described the four sets of one recommendation and three sets of options that could be used to avoid the panics that come from short-term funding. I want to go just a little bit over the history because it's very significant, and I've alluded to it already, which in the 17 and 1800s in the United States, we had banks with capital ranging in 25 to 50%, and with bank shareholders having double liability. And in this framework, we had huge financial panics, culminating in the financial panic of 2007, when everybody agreed we got to do something about this. We got to have a central bank that's going to help with this, and that led to the establishment of the Federal Reserve in 1913. So that was a central bank with the authority to act as a lender of last resort was going to be was intended as an important element in creating financial system stability. That sort of came apart a bit in the 1933 or 1929, when you had the Great Depression and the banking panic that came along with that. And the Fed at that time didn't really exercise its powers, and I think there was a consensus at that time that more needed to be done, and the major action that was taken was to create deposit insurance, and also then separated in investment and commercial banking. And that system worked for the next 74 years until 2007. We had lots of bank failures. We had the collapse of the thrift industry, the savings and loans in the United States. We had big financial problems in banks in the 1990s and many bank failures, but no bank panics, no people lining up outside banks to get their money, and no systemic consequences for the economy at large. And Congress Okay, Congress then said, okay, we have this now we've had a crisis, and let's do something to fix it. So, Dodd-Frank, I want to just list 7 of the changes that were made by Dodd-Frank that have contributed to a more stable financial system, and one which will remain stable, or hopefully will remain stable. First, with respect to capital, a higher leverage ratio and stronger risk-based capital requirements, a capital buffer requirement, a capital surcharge on systemically important banks, and a total loss absorbing capital for systemically important financial institutions this is intended to provide the capital necessary to recapitalize a failed, too big to fail bank without having to call on taxpayer funds. They provided new liquidity requirements, including a liquidity coverage ratio and a net stable funding ratio. Bank stress tests to identify the need for additional capital. A resolution strategy for failed or failing large, complex, systemically important bank and non-bank financial firms. Living wills to make the bankruptcy process more effective and more suitable for use for large, complex financial institutions, and a orderly liquidation authority that gives to the FDIC the ability to resolve large, complex, systemically important financial institutions without a taxpayer bailout. And there was institutional changes, including a Financial Stability Oversight Council to coordinate among financial regulators and designate large, complex, non-bank financial firms for enhanced prudential supervision. And it would be better to do the consolidation that Gaurav talked about, which I mentioned, but in the absence of that, the FSOC plays a critical role. And in addition, there was an Office of Financial Research to identify systemic risk to the financial system, an important addition, and a Consumer Protection Bureau to regulate retail market behavior, retail financial market behavior, and finally, an Office of National Insurance. In addition, another important change was a prohibition on speculative proprietary trading, the Volcker Rule that you've probably heard a great deal about. And it provided, as Gaurav indicated, enhanced supervision of payments, clearing, and settlement by central counterparties, a change that has some weaknesses which were recommended for cure by the report. So my conclusion is that, I'll turn to that. Less than a decade after being the epicenter of a global financial crisis, today the United States has the strongest and most diverse financial system of any major economy in the world. The relative strength of and resulting market confidence in U.S. banks has allowed them to expand their lending, the growth of which has returned during the last couple of years to a pace similar to that in the pre-crisis, pre-bubble years. However, there is criticism of this. And the Republicans in Congress have been highly critical of the Dodd-Frank Act. President Trump has also indicated that he believes that major changes in this law are necessarily, principally because it has discouraged bank lending. Other criticisms are focused on opposition to the Dodd-Frank provisions on orderly liquidation, because it allegedly supports bailouts of too big to fail banks rather than avoiding those bailouts. National Economic Council Director Gary Cohn and Treasury Secretary Mnuchin have suggested that Dodd-Frank requires changes. The most comprehensive criticism comes from that has been articulated so far has come from House Financial Services Committee Chairman Jeb Hanseling. He says that big banks are bigger and small banks are fewer. This is all due to Dodd-Frank. There are fewer community banks and credit unions serving the needs of small businesses and consumers. Dodd-Frank enshrines too big to fail into law, giving Washington bureaucrats the power to officially designate large financial firms as too big to fail, and then makes them eligible for taxpayer-funded bailouts. Dodd-Frank contributes to the weak performance of the economy and to the slow recovery from the 2007-2009 crisis. The share of able-bodied Americans in the labor force has hovered at the lowest level in nearly 40 years. Small business startups are at the lowest level in a generation. It is now harder for creditworthy Americans to buy a home. Services like free checking are being curtailed or eliminated because of Dodd-Frank. Bank fees have also increased due to Dodd-Frank costs on banks, and Dodd-Frank has had a negative effect on the level of bank lending. I find it hard to accept that Dodd-Frank is to blame. And in this response, please read the treatise by Kenneth Rogoff and Catherine Reinhardt entitled "This Time is Different." You'll find it to be a very interesting. It explains that it takes about 10 years for an economy to recover from a financial crisis. The book covers crises in periods from the 1600s to the present time. Rogoff Reinhardt's research tells us that the recovery is right on track with the history of recoveries in other countries and other times. The Choice Act 2.0, sponsored by Chairman Hensley, would dismantle much of the prudential regulatory requirements of Dodd-Frank and undermine the CFPB, the Consumer Financial Products Bureau, Protection Bureau. The original version of this legislation has passed the House of Representatives. He would allow banks that opted to adopt a somewhat higher capital requirement to be excused from essentially all reliance on essentially all aspects of regulation applicable to banks. In the first 2 centuries of this country's banks operated with very high levels of capital, between 25 and 50%, with double liability for shareholders. But we still had devastating financial panics and failures. More was needed to achieve a high level of financial system stability that was achieved with the establishment of the Federal Reserve and the adoption of deposit insurance. As is the case now, somewhat higher levels of capital alone, as proposed by Chairman Hensley, are insufficient to achieve financial market stability. President Trump has set out core principles that should be achieved in any new legislation and has ordered Secretary of the Treasury Mnuchin to make a study of any changes that need to be made taking into account the core principles. The core principles are not controversial and have been accepted by Federal Reserve Chair Yellen as appropriate criteria for considering legislative changes. The President has given Mnuchin 120 days to make this report, and it's something that you will want to take a big interest in and watch as to see exactly what the recommendations are made. The
Should we allow
position.
for some Q&A? I don't know how much time, do we have time?
Yeah, we have about 10 minutes.
Okay, I'll stop at that point. Let's.
Yeah, thank you both. Do we have any questions for our guest? I can start off with one. So, you mentioned one of the key components of the Financial Choice Act, the Republican sort of proposal to strip Dodd-Frank, is replacing Title II, which gives the FDIC orderly resolution authority with a new provision in the bankruptcy code. So I'm curious as to your thoughts about updating the bankruptcy code to facilitate sort of large bank unwind, and if it's sort of warranted, or whether you'd like to still have Title II and FDIC have the ability to unwind as well.
I'll just start with a response that adding a better bankruptcy code, as and there are various proposals around specifically directed at that, would be a positive addition. The whole premise of Dodd-Frank is that bankruptcy is going to be the tool used first. And the living will part of the bankruptcy, living will part of Dodd-Frank is intended to facilitate that. And giving the bankruptcy court the ability to have access to the orderly liquidation fund was probably essential, and that should be, if any change is made to the bankruptcy law to make it more accommodating, that should be part of it. Otherwise, it will not be able to work effectively. The other major question that I have is what kind of a resolution is going to be developed? Is it going to be a Chapter 11 revision, or is it going to be a Chapter 7 liquidation? Dodd-Frank calls, and I think that the American people want a firm that fails in that respect to not to be resuscitated, and that the firm should be liquidated. And so if that's the framework, it's going to be liquidation, it's going to have access to the orderly liquidation fund, I think it would make a positive contribution, so long as you keep have the option of using Title II if it's considered necessary for systemic reasons.
I agree with everything Mike just said. Look, I think we had the crisis. Too big to fail, not acceptable anymore. Stated preference in Dodd-Frank for bankruptcy. That means that the bankruptcy code has to be in such fashion that it can actually accommodate the failure of a large institution. There are two ways of doing that. One is the resolution planning exercise, which is put it all together in a living will, and supervisors go in, they look at the living wills, regulators look at those, and you rationalize the structure of these institutions. And the other way to do it is to make changes to the bankruptcy code so that the code itself can accommodate the failure resolution of a large financial institution. Some would argue that the resolution planning exercise could have been more effective in rationalizing the structure of these institutions. Some would say that it's sufficient, but the second piece is the bankruptcy. But I agree with Mike that it should be as a backstop, or the Title II should remain a backstop to bankruptcy resolution, and that getting rid of Title II altogether would be a real problem but allowing for the bankruptcy code to accommodate the large failure, and then to the extent that there's still a failure that could have a negative impact on the stability, that could allow for Title II to be triggered. That would be a much better approach than getting rid of Title II altogether in favor of a new Chapter 14 in the bankruptcy code.
Any more questions? Well, I'm going to get another one
Yeah.
as well. So, most of your recommendations when it comes to short-term wholesale funding seem to be targeted at the instruments themselves as opposed to kind of the entities absent the sort of resolution recommendation. So what are your thoughts about direct supervision of big, asset management players like BlackRock, which has been called for by many, and they've sort of advocated vigorously against?
Yeah. But Mike, you want to take that, or should I take first step?
You go to first on this one, I'll go,
Yeah, look, I think we have lots of different players in the financial system. There's lots of different types of financial institutions. Each of them has a different regulator with different standards. So it's hard to regulate at an entity-specific level. That's what we do currently. But the sort of the novel aspect of this report is that we're targeting the activities, we're targeting the practice, we're targeting the instruments, regardless of who trades in them, who engages in them. And so that aspect of it is actually an innovation that could be serve us well in terms of financial stability. So I would say that that's a very strong feature. In terms of direct regulation of individual sectors, look, I think another problem with our regulatory structure is that it's just a hodgepodge, and we need to have some mechanism to enlarge the perimeter of regulation. It's not, just banks. There are many other players that could become systemic. I mentioned CCPs. There might be other types of institutions. AIG is an insurance company, was systemic in the crisis. And so we need some sort of mechanism to enlarge the perimeter. That enlarging mechanism is currently housed in FSOC, and that has to be a very sort of robust process to really get a good understanding of the risks of particular institutions, whether those institutions should be more robustly regulated by the Federal Reserve or not, and also to look at the activities and practices. The FSOC actually talks about activities. The Dodd-Frank Act actually gives the FSOC the ability to designate activities and practices. So conceivably, they could designate repo as an activity. And so if anybody's engaged in that, they would have to play by those rules, regardless of whether that institution itself is a SIFI or not. I think the bigger question right now is the future of the FSOC. My view is, so long as we have a regulatory system as disjointed and as rigid as ours, you need some sort of a mechanism like FSOC to sort of take care of that perimeter problem that we have. Go ahead, Mike.
I would question your premise,
No premise.
because, well, it's the recommended incremental actions really depend on regulating different classes of instruments. That's true, but the three alternative proposals aren't dependent on that. One which is in a sense saying you regulate the borrowers, the short-term borrowers, and you regulate everyone that's a financial firm that's a short-term borrower would be limited in the amount of short-term debt that they could use to fund themselves. And this would be particularly directed at the shadow banks. And it doesn't depend on the SEC or any individual agency to enforce, nor is it directed to any individual type of firm, but it would apply to all firms that use the economic equivalent of short-term funding. So it would apply to specifically to debt or